Welcome back, guys, to another video of Forex Beginner's Guide. This is video 111, and this is about what is spread. So, in Forex trading, the spread is the difference between the buy price and the sell price of a currency pair. It's essentially the cost you pay to enter a trade and is one of the most important factors to consider when trading. Buy price, the price at which you can buy the currency pair. That's what the spread is for in a buy. Sell price, the price at which you can sell the currency pair with the spread. What is spread in Forex? The spread is measured in pips and varies depending on several factors, such as the liquidity of the currency pair, the time of the day, and the broker you're using. Example, in the case of XAUUSD, which is gold versus US dollar, the difference between the buy and the sell prices might be 0.10 pips. This means if you enter a trade, the market has to move 0.10 pips in your favor before you start making a profit. How the spread works. Let's take an example with XAUUSD pair. Buy price 1800.50, sell price 1800. The spread is the difference between these two prices, which is the case, which in the case is dollars 0.50, which is 50 cents. When you enter the market, you're buying at the higher price and selling at the lower price. This means that right from the start, the price would have to move in your favor to make a profit. For example, if you enter a buy trade at $1,800.50, you need the price to move above 1,850 cents for you to start making profit. If you enter a buy trade at 1850, you'll need to move it. If you, sorry, it's the wrong wording here. If you sell at 1850, you need the price to be below $1,800.50 for you to start making money. Types of spread. The first one is fixed spread. A fixed spread remains constant regardless of market conditions. It's beneficial because you know exactly what your transaction cost will be. However, it can be slightly higher than the variable spread, especially during quiet market conditions. Variable spread. A variable spread fluctuates depending on the market condition, such as volatility, liquidity, and the time of the day. For example, during high volatility, example during major news events, the spreads may widen, meaning you'll pay more to enter a trade. During low volatility, like the Tokyo session, spreads tend to be tighter. Why is spread important in trading? Number one, cost of trading. The spread is a cost you pay to trade in the market. The narrower the spread, the less you'll pay in transaction costs. Traders prefer tight spreads as it allows them to make a profit quicker. For XAUUSD traders, a tight spread means that the market doesn't have to move as much in your favor for you to make a profit. Second point, liquidity and market condition. Pairs with high liquidity, such as XAUUSD, usually have tighter spreads because they are more actively traded. However, during periods of low liquidity or high volatility, spreads can widen, increasing your cost to enter or exit a trade. Number three, scalping and day trading. If you're a scalper or day trader, you'll want to pay close attention to spread. A tight spread allows you to enter and exit a position quickly without paying much transaction cost. In fact, moving markets like XAUUSD, the tighter spread can significantly improve your profitability. Example of spread in XAUUSD. Let's assume you're trading gold. The buy price is $1,800.50 and sell price is 1,800 with a spread of 0.50 pips. If you decide to buy $1,800.50, the price needs to be above $1,800.50 for you to gain the profit. If the price moves up by 1 pip, so from 1,850 to 1,860, you would start seeing the small profits. However, if the price goes the other way and falls below the mentioned zone, you will be at loss and the position needs to recover and the spread before making any profit. That was all about spread, guys. I hope it all made sense. Make sure you all watch all the other videos before you start trading. See you guys in the next video.